Hi, I'm Tyler Ballhorn, and this is the Stockscores Market Minutes for January 12th, 2015. Happy New Year, everyone. This is our first Market Minutes video of the year, and this week's topic, stop trying to make money. Most traders focus on making money and avoiding the loss of their capital, and most traders that are at least normal human beings have an emotional attachment to money, and therefore this money-centered focus tends to cause most trading mistakes. To be a better trader, you need to take money out of the decision-making process. Focus on reward for risk or some other non-financial metric. When you focus on the money, it is too easy to get your emotions involved, and as a result, you make mistakes. To do well in the market, ironically, you have to stop trying to make money and instead just try to make good trades. Well, let's see what the market tells us this week. Of course, we've been in a very long-term upward trend. We can see that very orderly upward sloping channel. What is notable to me when I look at this chart is that over the last 3 months, we've had a pickup in volatility where the swings up and down are greater than they have been for most of this trend. And that's really because the market is expecting that the U.S. Federal Reserve will start to raise interest rates sometime in 2015. And that will make the market more volatile because in the current market where we've got the Fed stimulating the economy with the printing of capital, with the buying of bonds, with low interest rates, all of those things help the stock market and really put a base of buying support under the market, which takes out a lot of the volatility. Well, what we've seen in the last few months is slowly a return back to how markets normally behave, which is with a good deal of volatility. I actually welcome that change because it makes trading a lot more enjoyable. Now, this past week we had some selling pressure, really since the start of the year and just as 2014 was coming to a close, we've had some selling pressure. It took the market down to support. It bounced back pretty nicely at the end of last week, and I think that we will stay in this upward sloping channel. With that said, we should note that right here, this top right here, which was 2 weeks ago, is more or less the same as the top back in December. And that tells me that we could be going into a sideways trading range here. And I think we have to be fairly watchful of the market right now because, again, the market is looking toward the possibility that interest rates start to go up. Plus, you've got a good deal of problems over in Europe with their economy, problems in Japan as well. So we're starting to see a little bit of hesitancy by the buyers at these price levels. So as for now, remains a bull market, but I do think we want to watch carefully to see if we get a breakdown from a falling top on this chart. All right, the small cap stocks in the US have been stuck under resistance for more or less a year, and they tested that resistance again, couldn't break through, but that is, I think, the chart to watch. If we get a breakout through that 122, 123 on the IWM, I think that the money is going to start to move out of large caps, the safety of large caps, and really that sector of the market that has benefited most from low interest rates and quantitative easing, and it's going to start to look for places to get some better returns, and I think that'll be in the small caps. So I think this could be the story of 2015, but I don't get too optimistic until we get that breakout through resistance at 121 or so. Here's a chart of the TSX 60, and you can see that we've got falling tops building on this chart. We've got one here in December, another one, that was November, another one here in December, and as we start this year, we're getting a breakdown. I think we're going to test the line of support that I've drawn, the green line of support, and I'm worried because of these falling tops. That means that the sellers have taken over control. Story here, of course, is the weakness in energy, which is, a big part of the TSX. There are areas of strength in the TSX. We shouldn't judge the market solely by this index because it's really energy and I would say mining to a certain degree, and then everything else. And a lot of the everything else is actually doing okay. So you just have to pick your spots on the TSX. I can't say the same thing for the TSX Venture. It's ugly all around. Commodity stocks are very weak, and they, of course, dominate the TSX Venture market. Until we start to see a build of rising bottoms here, I wouldn't get too optimistic, and I think this is a market to avoid right now unless you are looking at particular stories that are really captured the market's interest. And those come along, but there's just not too many of those right now. Treasuries have gone parabolic. You can see I've drawn a green upward trend line that is getting steeper over time, and that trend is now coming into long-term resistance at the 2012 highs. That means there's a good chance we will see bond prices pull back, which means a rise in interest rates. However, interest rates right now are very low. I mean, we're talking about treasuries that are dipping below 2%, and that is a good thing for the housing market, for real estate stocks in general, and you can see that there's been some strength in those areas. I think that the treasury is going to get stuck here for a little bit and work their way back to the linear, straight upward trend line. US dollar, very strong. Again, the problems in Europe, a big reason for this. Will Greece exit the euro? All of those questions that are arising. And then now some even talking about France exiting the euro. And if that European Union starts to crumble, this is really going to make the euro weak, of course, but also the US dollar strong as people go for that flight to safety. I would say a little overbought right now. It's at the top of the upward sloping channel, so due for a little bit of a pullback, but no sign of weakness yet. So I remain bullish on the US dollar, but I do think it's becoming a bit of a chase higher here. Gold is probably benefiting a little bit from the weakness in Europe. Despite the strength in the US dollar, gold actually has been doing okay, but in the big picture, we're really still in a downward trend, falling tops. All that's happening right now is gold is working its way back up to the downward trend line. So I think if you want to be a buyer of the gold stocks right now, you got to treat it as a very short-term trade. You can benefit from a little bit of the bounce back in gold, similar to what happened at the start of 2014. We're seeing a little bit of a bounce back starting now in 2015, but I just don't think it has the same upside potential. I think we're going to see this rally fizzle out, barring a real breakdown in the euro. Oil is ugly. There's really no other way to say it. The trend is very steep, but also linear. It's actually a pretty orderly, I would say orderly but very bad market to the downside, but there's just no sign of a bottom yet. So avoid this market until you see some signs of reversal. There really aren't any signs of a reversal yet. You can see the volatility index, the VXX, has been really showing some life through December, and again, that's related to the fact that the market's starting to worry about interest rates going up, problems in Europe, that sort of thing. And certainly with a rise in volatility, I love that as a trader. I think it's a good thing, but it also means that the buy and hold type portfolio, you got to be a little careful with that, because we could see that sort of thing start to break its upward trend. So I am bullish on U.S. stocks long term, neutral in the short term. We did have a little bit of volatility and weakness last week that I think will carry over into next week. Canadian stocks bearish on both time frames, but again, that's particular to the TSX index. But if you look at certain areas of the TSX, actually doing okay. So you really got to pick your spots on the Toronto Stock Exchange. Gold bearish long term, neutral short term. It is trying to stabilize, but it still hasn't broken that long-term pessimism. And oil bearish on both time frames. U.S. stocks remain in their long-term upward trend, but the increased volatility recently indicates that uncertainty is increasing. Canadian stocks continue to fight weakness in energy. There are pockets of strength on the Canadian market, but we have to be pretty particular where we trade in the Canadian markets. Gold will likely continue to show short-term counter-trend strength, but really be careful longer term. And there's really no other word for oil. It is ugly right now. Well, that has been the Stockscores Market Minutes for January 12th, 2015. Have a great week in the market and trade well.